Good morning, good afternoon, everyone, and welcome to our session on the direction of the US economy in 2021, where we'll focus on the likely implementability and impact of the new administration's plans and other issues affecting the US economy and global affairs as well, COVID. Thank you very much for joining us. I'm John Orchard, OMFIF's CEO. With us today are Nathan Sheets. He's Chief Economist and Head of Global Macroeconomic Research at PG and Fixed Income, and before that was, among several other things, also at the US Treasury and at the Federal Reserve. We also have James Sweeney, the Chief Economist for Credit Suisse and Regional CIO Americas for the International Wealth Management Division based in New York. He's also a member of the American Pension Investment Committee and in an earlier life was a political speechwriter. And we have with us our US Chairman, Mark Sobel, just getting through a tech hurdle, but be with us in just a moment. He was also at the US Treasury and as such knows a number of the people returning there. And we'll ask him about those. Mark represented the US at a number of key multilateral organizations and has written from OMFIF about the US's engagement with them in the future. Bit of housekeeping before we get going. This is a public meeting and being recorded. We very much welcome audience participation, so do please post your questions in the comment section and I'll start bringing them into the discussion after about 20 minutes. Our regulars will notice this session is in Zoom and not GoTo. I doubt after all these lockdown months we need instructions on how to use it, perhaps except for Mark, but he'll be with us in a moment. We'll kick off. We'll come to economic forecasts shortly, but I wanted to start with policy and politics. OMFIF ran a session just after the presidential election where we looked at likely economic policy, but spent quite a bit of time assuming the Democrats would have to work around Congress. Now that they have theoretical control, policy looks at least superficially easier to implement. So firstly, I want to look at whether that's true, and if so, what policies might we see passing the legislature which would have been thwarted before. I'm going to turn to you first, Nathan. What are your thoughts on, now that we've had the Georgia result? It looks like a slightly more proactive approach from the Democrats, and the president is more implementable than before. Do you think that's true?
So first of all, let me just say it's wonderful to be here. Always great to have a chance to participate in events that are hosted by OMFIF. I think the fact that the Democrats won the Senate means that Biden's nominees are going to have an easier time getting through. That means that these executive branch agencies are going to get staffed up more quickly, and the executive side of the government is going to be more empowered more rapidly than it would have been otherwise. Secondly, and I think this one is pretty important, that in the Senate, the Democrats are going to be setting the agenda. If Republicans were in control, the way one analyst described it is it would have been Mother May I between Joe Biden, Chuck Schumer, and Mitch McConnell. And now the Democrats can set the agenda, and that's important. All of that said, bottom line, my sense is that with a 50-50 Senate and a narrowly divided House, that it's still going to be a lot of gridlock. And I think we're already starting to see that in some of the discussions that are emerging on stimulus and some other measures. It's even taken them some time to figure out how they're going to share power in the Senate. So it's likely to be a long, slow slog, nevertheless, in the legislature for the Biden administration.
Thanks, Nathan. James, do you think, what do you see as the prospects for this proactive campaign on economics from the Biden administration to get through Parliament more easily, notwithstanding the fact it's a very slim majority and the Democratic Party is not a homogenous thing?
Well, I mean, first of all, I agree very much with what Nathan just said. We have shifted from a clear gridlock scenario when the Democrats didn't have a majority, to a much less gridlock scenario. I wouldn't call it quite a blue sweep that allows the Democrats to do whatever they want. It might be that the gridlock is now about, Joe Manchin or relatively centrist Democratic senators who might disagree with a full Biden legislative agenda. I think what this means is the Democrats, the Democrat majority leader Schumer in the Senate can define what goes to the floor, can define what will be negotiated. It's unlikely for large fiscal legislation to achieve 60 votes or 50 plus 10 Republicans to get around the budget reconciliation, to get around the filibuster process. And therefore, the budget reconciliation rules will likely apply to any major fiscal changes we see. But I think within those rules, there's actually room for a large amount of stimulus. And right now, Biden's talking about an immediate pandemic relief bill, another one, in addition to the $900 billion we got in December. He said 1.9 trillion. He said bipartisan, probably will be half that big. Almost surely will not be bipartisan, but that's still meaningful legislation. And then beyond that, you're looking at, the campaign ambitions of infrastructure and green investment. I think they will pursue that. And I think it is realistic for them to get some version of that, but there's a lot of specific decisions to be made, and they're not going to have carte blanche to go huge, but I think it will be huge enough what they're able to do.
Okay, thank you. We'll explore some of that. I mean, in the package, there are things like minimum wage, which typically gets snarled up in parliamentary debates, and we can come back to those, and infrastructure. Mark, what do you see as the prospects for at least the more moderate end of the Democrat package to get through Parliament? Where will they be able to secure the help of moderate Republicans, and where not, specifically?
Thank you for having me. I pretty much agree fully with what Nathan and James have said. I guess the one thing I would draw out a bit is that there are centrist forces in the House, and they're going to be the centrists, as James mentioned, in the Senate. And I think that getting those centrist forces aligned will be key in getting legislation through. And that means there are going to be a lot of unhappy progressives in Washington, DC. In terms of your question, John, I think the way I think about that is to go through the items. I think that there's been so much talk about the $2,000 checks. Something has to happen on that. But some of the targeting of the checks was very suboptimal in my view. Very well-off families with workers and kids could have been getting thousands of dollars, which didn't make particularly sense to me. So I think that by playing with how many people in a family would get it and some of the income thresholds and whatnot, that is an area that can definitely be looked at. There's a lot of money in the pipeline already for health. They can look at how much money is there for health and education. I think things like rental support should not be too controversial. Unemployment insurance is now going through, the supplemental unemployment insurance is going through the end of March. I think that's going to be extended. And Biden wants it at 400, whereas it's 300 now through the end of March. Biden wants it to the end of September. That's a definite area where I think there could be receptivity. State and local could once again be very controversial. A lot of Republicans say, well, it's just wasted money on poorly run Democrat cities. Some states are doing well. Others are experiencing huge revenues declines. I think that could be controversial. I think it's area though that could be much better targeted. So I think that there is room for maneuver, and I think Biden has already begun to suggest that he's amenable to looking for room for maneuver.
Okay, so you're suggesting that stimulus bill is a very big, slightly poorly aimed gun, I think, and you think that perhaps enough Republicans will think that too for it to be narrowed in scope.
And as James and most analysts have said, they could envisage something plus or minus $1 trillion. That'd be another 4.5% of GDP. That's a good chunk of money, especially on top of 4.5% of GDP in December. So, I think that might be where most people, most analysts and experts think we may shake out.
Okay. And do you think something like the minimum wage, I think it's $15 or thereabouts, will get through? I mean, those proposals aren't directly related to borrowing, of course, but people do have differing views on their benefit to the economy, and it's a very political area. What do you think will happen with a topic like that? Mark first.
I have no better view than what I read from the experts and the analysts. I don't expect $15 minimum wage to make it through.
Nathan?
I agree with Mark. I think it is politically contentious still. I think the evidence for it is frankly quite compelling, that where the minimum wage has been raised, we've seen increases in wage payments to lower paid workers with very little signature of that in unemployment. So I think that if you phased it in gradually over time, maybe with some additional riders about local conditions and wage rates, it could be powerful. But it's still politically contentious. And importantly, it is likely to be seen as not directly related to the budget. And hence, under the Byrd rule, could not be done under reconciliation, and will require 60 votes. And I think that's very unlikely.
That's useful. James, would you agree?
Yes, my understanding is the same, that that it is not a revenue bill and therefore is ineligible to be done under reconciliation, and therefore essentially has no prospects. It's just a political idea thrown out there. I would agree with Nathan that where you've seen increases in minimum wages is arguably been helpful and a positive dynamic. But of course, the places that have self-chosen to raise minimum wages are ones that, it would likely be appropriate. I think in some very low wage states that often benefit from, relocation of factories and things like that, could actually lose out by a national $15 minimum wage. So the local riders and things like that Nathan also mentioned would be very important if they eventually did it, but we don't expect that anytime soon.
I think here is a good example of the fact that this is a contentious and difficult issue. Just before we go on to look at the effects of the stimulus on the economy and also of the immediate COVID relief and what effect that might have, are there other areas that will be particularly contentious? One thinks of progressive taxation. What do we see there, Nathan? There are obviously, Biden went into the election with campaign promises on income levels who would pay greater amounts of tax. There are probably quite a lot of people who are against that.
So I would put a 0 probability on getting bipartisan consensus on higher taxes. So we're very much, as we talk about tax increases, we're very much in the 50 vote reconciliation world. And then it's a discussion of whether you can carry all 50 of the Democrats in favor of tax increases. And I think that the jury is still very much out on that. If it does happen, it's likely to be a much more delimited set than the tax increases that Joe Biden campaigned on. Maybe a modest increase in the corporate tax rate from 21, where Trump moved it to 25 or 26%. An increase in the inheritance tax, and possibly an increase in the top tax rate back up to 39%, which is where it was before Trump as well. But it would be a limited set compared to those that Biden campaigned on.
Do you agree with that, James? It's sort of quite a modest set of changes rather than a social democratic agenda on tax?
Yeah, it's due to the political situation and the 50-50 vote in the Senate, in which it would likely get through with the agreement of some moderate senators. I agree there'll be negotiations. You will negotiate down from the set of tax hikes in Biden's platform, which are quite extensive for households over $400,000, and for not just corporates overall going to 28, but there's a global minimum. There's an intangible tax change. There's a number of things potentially on the table, but it will have to get negotiated. And of course, these tax increases are likely to be in the context of a later stimulus bill, which includes infrastructure and green investment, not this pandemic relief bill, which is coming up now. And that bill will require some revenue to offset some of this spending. So the tax increases can raise that revenue. Another issue is, in the past, tax increases in budget reconciliation bills have been delayed. And we are, of course, in a recession, arguably still. And we have, we have a big output gap. So I wonder whether delaying the tax increases, legislating them, but having them start a few years out is another option, as well as excluding specific features of Biden's platform.
Okay, and the people worry a little bit less about debt sustainability at sovereign level than they used to, and we'll come on to that in a minute. So maybe that's easier to do than it would have been 10 years ago. Mark, just very briefly on taxes and the negotiations between the let's call it two halves of the Democrat Party. Sometimes the moderate wing of these parties then has to throw things at the more radical end in order to keep going. So if you think of the UK example, it would be Tony Blair banning fox hunting in order to keep quiet the left wing of the Labour Party, even though he didn't really care about it, thought it was a waste of time. What will you see in that kind of regard with respect to the Democrat Party, perhaps?
Oh, you've got me there, John. I just wanted to kind of agree with Nathan and James on what they just said. This is going to be a later tax increases will be on the table much later down the road, and it will be packaged with infrastructure. Some revenue offset will help, though. Using 10-year windows and sunsets, we totally fudge and finagle the rule that reconciliation need not require, must not involve in a higher deficit down the road. So I have to really give some hard thought to your question. I don't have a good answer at this time. I'm sorry.
Fair enough.
Nathan, do you have an idea?
My thinking on that question is Joe Biden has done a fair amount of that with this first round of executive orders. I think when you look across those topics, there is a lot of old-time religion for the Bernie Sanders wing of the party. And so I think he's moved in that direction, which hopefully will give him legislative space to do some of these things we're discussing that are more at the center. But I think you'll have to address those concerns executively, and you won't be able to get it through the legislature.
There is the point that the 1.9 was seen as going big, and it was intentionally seen as a politically tactical going big for and maximalists to make the point that Nathan is making, if that's what you're looking for, John. So you take the state and local. Biden knows that is extremely controversial, fairly or not, and that I think he had to know going into it that he wasn't going to get that, and that maybe some of the requests on education and vaccine spending were inflated for these purposes. So I think that that going maximalist now could be seen as a way of creating space to pare back to the center.
In other words,
I would just quickly add that salt tax exemption is an interesting question too, relating to all of this when the tax increases eventually, if they happen. For those who don't know, the salt tax exemption is state and local taxes being exempted from federal taxes, which caused taxpayers in high tax states like New York and California not to benefit from the president's tax cuts a few years ago, President Trump's. And where this is interesting is that a lot of progressives would be strongly against changing Trump's rule on this one. But I think so far I've heard squirrely comments from the administration out of this, and not a clear view on whether that one is in play. And it is reasonable. It is meaningful from a revenue perspective, and just generally interesting in touching on all the topics we've mentioned.
That's very useful. Mark, just if I may, a crude summary of what you said. I think what you're saying is that party management will work through Biden asking for things of Congress he knows aren't going to get through, which will then be negotiated down. I think that's what you said.
I think in the case of the bill that is on the table right now, the 1.9 trillion package, I think that's definitely the case. And we'll see how he proceeds on infrastructure and taxes later, but there's going to be a huge push on that bill to get to the center if there's going to be a bill. And the other thing is that that bill will be probably the best shot Biden has, other than through regulation, to push his climate agenda. And so that's going to be another tension point, I think, in that bill. But he said that would be next month. We'll see if it comes next month or in a few more months, but that would be worth watching in the near term space.
Okay, great. Thank you. We'll move on now to the impact of COVID on the economy. We've heard Lagarde earlier today saying, conceding that the new variant and so on is going to retard economic recovery, or delay it rather than get rid of it altogether. In the US, I will just briefly explore whether the change of administration will make any difference to the impact that COVID will have on the economy. So you can imagine, on the one hand, the vaccination program might be sped up or end up with more money attached to it. On the other, the government might encourage more caution with respect to lockdowns, although the states themselves have significant control there. How do you see the pandemic course changing, if at all, as a result of the administration change? Just very briefly, Nathan.
So one big difference is we're more likely to see additional stimulus. I agree with James and Mark that a trillion or so is likely. I think it's one of the limited set of proposals that have a chance. I'd say beyond that, the Biden administration will have credibility with certain parts of society where the Trump administration didn't have credibility. But that's probably true in reverse as well. And I think Biden is fine-tuning Operation Warp Speed, but I think that Trump's team probably would have fine-tuned Operation Warp Speed. So in my mind, the biggest difference is not really on the vaccine or virus side, but it's on the stimulus side.
Okay, James, would you agree that the government's treatment of the pandemic itself would make a material difference to economic forecasts, but the degree of the stimulus will make a difference?
The stimulus will make a difference, and actually, the success of the vaccinations obviously will make a difference. And one thing which is really not policy related is whether these new, more contagious virus variants actually hit the US in the short term and lead to a new peak in infections. Those are basically the three major risks clouding the outlook at the moment. And I suppose the new administration contributes most to the fiscal side.
One of our members, an alternative asset manager, thinks certainly Europe is making mistakes there and has underestimated the impact of the new variants with extended lockdowns and so forth, and are suggesting that people pare back their recovery numbers. Well, we're going to come on in a moment to your specific predictions on economic growth. Just while we're reviewing what the new government may do, you've all mentioned infrastructure. What do you think that we'll see there? So is infrastructure, for example, as I think Mark said, the most likely policy that could get bipartisan support by way of stimulus? I mean, Donald Trump was already talking about it 4 years ago, in fact. Nathan.
So the stimulus package, I agree with Mark. It's going to start, or the infrastructure rather, package is going to start very large. probably several trillions, 3, 4, perhaps trillion will be in the original package. And it's going to be very broad with bricks and mortar infrastructure, green kinds of things, broadband. It may even get into aspects of healthcare and education. Now, at the end of the day, I think we're likely to be, again, through the same kind of process we've described, we're likely to land somewhere maybe at 2 trillion or a little bit smaller. And it will most likely, again, need to be done through reconciliation. And you're broadly asking yourself the question, how much will Joe Manchin and Kristen Sinema, some of the other moderates in the Senate, be able to swallow? But it will be smaller, but it will broadly echo Biden's priorities with bricks and mortar, environment, some tech stuff, broadband, and so forth.
James, do you think bipartisan support, broadly speaking, for infrastructure stimulus?
I mean, they say it, but of course, the Senate Republicans have blocked infrastructure for years, including when you had full Republican control. So the devil is in the detail with infrastructure. It can be many things, and it can include many specific projects that actually are a little bit more partisan. So I guess an interesting thing will be, it won't get done. It will get done through budget reconciliation, which means it only 50 votes. Certain things could potentially lose a Senator Manchin from his vote, from a coal production state of West Virginia, but maybe there are other things that could bring in a stray Republican vote or two in exchange for, perhaps job creating investments in those states. So, but in general, I agree with Nathan broadly on composition and size.
Do you mean essentially that they can use pork to get it through?
In as much as the stimulus bill always contains a lot of pork, there's going to be a lot of specific investments that there's room to put those things in certain places. I'd put it that way.
Okay. Do you agree with that, Mark? I mean, that the environmental agenda isn't always shared by everyone, and that's one key plank of the infrastructure stimulus. What's your view on the likely impact of the infrastructure plans?
I basically agree with what I've heard. And again, on environment, yes, there is the coal issue that James just mentioned. But on the other hand, there's a major move in the US on renewables, and a lot of renewables are produced in red states. And so, I think that there are things that can be done there. And I can only conclude that it would be utterly shocking to me if there were pork in US legislation.
Good. Okay, we'll move on now to more specifically the economy, inflation, growth, and so forth, and what that means. That's our core job to work out. If anyone would like to ask a question, please do let me know. We haven't had any yet on the Q&A chat function, but I'm very keen to get them. Very happy. I've got plenty to ask, but if you, as the audience do, I'd love to engage with that too and put that to our participants. So moving on now to specific forecasts. James, what is Credit Suisse expecting by way of growth in 2021 for the US economy in aggregate? We've seen, say, 8%, I think.
6.6% real GDP growth is what we expect for 2021. And I think it will be a strong year, and I think the strong year hasn't begun yet because of the pandemic. So a critical question is, at what point, hopefully in the second quarter, does a reduction in infections and a surge in vaccinations lead to the service sector starting to spring back to life? I think that will happen well before we get to herd immunity in terms of COVID. And I think this can happen in Q2.
Okay, and you're not too worried, the issue we were talking about a moment ago about the new variant being more transmissible and some say more lethal. You're not factoring that or seeing the need to change your calculations at the moment for the US economy on that basis?
Big error bands around forecasts as a result of that. But I think President Biden's ambition to vaccinate 1 million people a day for 100 days is very realistic. And I think the Johnson & Johnson vaccine is likely to be approved in the weeks ahead. And that actually gives us a strong chance of having a pretty large share of the population having acquired immunity from the virus by the middle of the year, which I think puts people in restaurants and on flights in the spring.
Nathan, what's PGIM think for growth this year? Any takers above 6.6?
So I'm going to go beneath that. My baseline would be for U.S. growth probably around 5.5%. Now that said, qualitatively, I would broadly agree with the story that James told. But where I'm one notch more cautious is how quickly all of that's going to happen. As James indicated, in order to get to a 6.5, and this is true certainly even more so for some of the higher forecasts, 7s and 8s that are out there as well, you need to have a very strong second quarter, which I think either reflects a very big stimulus package hitting the income stream, or the supportive effects of these vaccines hitting harder and sooner than I currently expect. So my baseline is 5.5% growth with a backloaded kind of second half rebound in spending. There's a lot of savings in the household sector. By our estimation, around $1.5 trillion of trapped in savings that's amassed during the pandemic. And if even a fraction of that is disgorged through the recovery, we could see very strong growth in the United States. But I expect that to be more Q3, Q4. If I move that into Q2, then I'd have a number in Q3, then I'd have a number more like James.
Okay, thanks.
If I may just respond
Please.
to that, and forecasting disposable income, if you get $1 trillion pandemic relief bill soon, which includes checks to a lot of households, and I think the checks may not be $1,400 to all households as has been laid out, or almost all households. But if you get something like that pandemic relief bill, disposable income is going to have a surge similar to what happened last spring. But this time it's happening at the end of the pandemic rather than the beginning. So unless we have that very sharp surge in infections driven by maybe new variants, I do specifically think that Q2 can see a lot of growth. So I think that is the difference in the forecast.
Yeah, and my question would be, how big are those checks? And secondly, how quickly are they spent? But I think James's story is a plausible and important one for investors and market practitioners to bear in mind.
Thank you. So Q2, the key one there. Mark, you've raised the savings point before. Do you have views on the growth rate of the US as we go through the year?
I'm going to leave the forecasting to Nathan and James. What I would underscore is that they're basically telling a very similar story. And James's story is a little bit more front-loaded than Nathan. But what they're saying is, now look, we haven't done a good job on dealing with the crisis, and in a way people act as if they don't care. So maybe the upside from vaccination isn't as strong as we think. But on the other hand, with the stimulus and just saving, I certainly see the ingredients for a major second half. And I think Nathan raised the right question. Does it start earlier or not? But in a way, I think they're, if you ask them what would be the level of GDP at the end of the first quarter of 22, they'll probably come to a very similar answer. So I think I would basically just agree with the shape that they're outlining. I think that's the main point.
Okay, and certainly a bigger number than the inflation expectation. I know they don't have to be the same, but that's, if anything, suggesting that that the retail public is underestimating growth, perhaps, who knows. I've had a couple of questions in, just to go back briefly to the political process before we go on to look at debt and inflation. Question from Neil Williams. Does the panel see raising of the debt ceiling by summer in any way an issue this time? And would any political capital be made of China's $1.1 trillion claim on it? Two quite separate points, but very interesting. Nathan, do you have a view? The government borrowing has many aspects, including whether the government has permission to do it by Congress.
You know, another difference of this democratic control, narrow democratic control in the Senate, is the mechanisms the Republicans might use to try to block that are now greatly limited. So I would conclude that the prospects for getting the debt ceiling raised are better than they would be. And I guess I would stick my neck out and say under these circumstances, I'm fairly comfortable that we'll be able to do that in a non-disruptive kind of way. And then the question about China debt ownership, I certainly hope that doesn't become a political issue. If we start kind of discussing those sorts of things, saying we don't like some of our creditors, I see that as a road to financial oblivion for the United States. So I certainly hope it's not. Doesn't mean that some won't, but I don't think that's in the mainstream. It's certainly not what the moderates are saying.
Well, so there's the old adage that if you owe the bank £100, it's your problem, and if you owe them a million, it's theirs. James, your thoughts on the debt ceiling?
I've been surprised to receive this question a few times lately also, given the Democrat control of the Senate and the House. Nathan chose his words carefully there, where he said the ways in which the Republicans can disrupt raising the debt ceiling are limited. He didn't say they're gone. To be honest, I don't actually understand precisely what they could do to stop it, given the Democratic control. So I'll go with the conclusion that this shouldn't be an issue. But there's a little bit of legalese there. And the fact that the question still exists definitely means someone like me needs to do a little more research on this.
Okay, well, that's very useful. Mark, I'm not going to ask you about the debt ceiling, but I'm going to ask you.
But I want to make a point. I want to make just 2 points, John.
I want to ask you about China. Go ahead.
I was going to answer the China one too. So just on the debt ceiling, always a threat. Everybody knows it's a totally ridiculous game. The Treasury is just paying the bills that the Congress told us to pay, and that's why we hit the debt ceiling. It's absolute hypocrisy. That said, I think even a goodly number of the Republicans know that it would not be a good thing for the United States to default on its debt. So we always somehow manage to get through it with all these politically absurd histrionics. It's a disgrace. Just on China, you know, Nathan and I have spent a lot of times with the Chinese SAFE and the PBOC. They are responsible professionals in managing their portfolio. They are not interested in disrupting financial markets. They may be interested in flipping out of treasuries and going into agencies to pick up some yield here and there or whatnot. But, you know, this idea that China has us, you know, holding this over our head and it's going to get us is not a story that I've ever believed in my dealings with them over the year. And I think the current Treasury will, the Treasury will be responsible in its debt management too. So my baseline is we will deal with this issue comfortably as we have in the past. There are the Treasury and the Chinese central bank talk to each other.
We talked about this a little bit last time. We don't need to go over it again. In terms of overall China policy, we somewhat came to the conclusion of iron fist in velvet glove instead of iron fist in iron glove as the difference between Trump and Biden. Do you think that's right, Mark?
I'd be very interested in hearing what our panelists say, but in essence, I do. I think that you know, Trump was all about attack mode and ripping things up and going the bilateral route. I think that, you know, China is seen as a strategic competitor across the board in the United States. I think that there are very legitimate gripes about state capitalism, industrial policy, force tech, and whatnot. And those are going to be pursued. I think there are legitimate concerns on the technology front, but I fully expect that the Biden team will be more engaging of China. They will recognize that there are areas, climate, health, global financial stability, where there are common aspirations, and they will want to cooperate. And even where it's not going to be possible to cooperate, or where things aren't going to be smooth, I expect them to talk a lot more behind the scenes. So I expect a much calmer set of relationships, though the strategic competition and the tensions will fully remain.
And there's quite a complicated strategic competition with respect to currency. We won't talk about that now. Please do join any of our Digital Monetary Institute sessions on that. But the proliferation of a digital currency, China is 5 years ahead, I'd say, may also be an issue. But we won't go into that now. I had some more questions I think are relevant, and then I'd like to go back to the idea of inflation that James wrote very usefully for us about overnight. A question from Patrick Flynn. Biden has picked some progressives in the economics team, and the example here from Patrick is Heather Abuchi, who promotes equal but better growth, and Yellen has her eye on maximum employment for the less off, and certainly she's a notorious Keynesian, I think. What impact will this have on Biden policy, this a focus on full employment, which of course the Fed has loosened its definitions of? Over to you, Nathan.
A core part of Biden's policies is a deep concern about inequality in the economy. And I think that concern takes many different forms. It's a worry about wealth inequality and income inequality, which you see manifest in some of the tax policies and the rhetoric there. It is a concern about access to opportunity, which I think you'll see addressed in legislation that will be proposed on education. But I think it's also going to be captured in some of the infrastructure that's going to be proposed. And then there's the issue of ensuring employment. And when I think about Janet Yellen arriving at the Treasury, job one for the Yellen Treasury, and frankly, job one for the Biden administration, is getting people back to work, and doing that in as equitable, as fair, and even-handed manner as possible. And so I think that this progressivism, if you will, or concerns about income and wealth distribution and the distribution of opportunities in the economy is at the very core, it's the very center of Biden's agenda. And we will hear a lot about these issues during the 4 years ahead.
And do you think that you'll end up, are there potential risks in having that policy as well as a super lax Fed? Nathan.
I think that we are in a world where the levers of government, we're pulling them, particularly on economic policy, where we've got a lot of fiscal stimulus, we've got a lot of monetary stimulus. And I think the underlying narrative as it pertains to inequality is that the very worst thing for those that are in the lower half of the income distribution is for the economy to be weak and for them to be unemployed. And the flip side, I think the evidence also suggests that to the extent that we can deliver a strong, robust economy, that's very helpful for income distribution. And indeed, during the last few years before the pandemic, we were making a little bit of progress in bringing up the wages of some of the lower paid workers. But it will also manifest itself in other ways, going back to our discussion on the minimum wage and so forth.
Mark, what would you expect from Yellen in terms of policy, but also temperamentally? We talked about that a bit before. She's been confirmed in the meanwhile at the Treasury. How important will full employment as an idea and objective be to her, and how do you expect that to manifest itself in policy?
You know, she's one who very strongly believes in tackling inequality and in having strong labor markets. And we're going to see, as we've been discussing fiscal stimulus, we're going to see a hugely accommodative Fed. You know, we thought Nehru might be 4-ish, but we saw unemployment go down to 3.5 before the pandemic, and the Fed under Powell was more than willing to run the economy hot, and we weren't seeing inflation. So I very much expect very strong support for tackling inequality and pursuing a very strong economy that will help workers. I mean, you know, just looking more broadly at a Yellen Treasury, I think it's worth noting that she's going to be very focused on promoting climate. I expect a tougher set of financial regulation, particularly dealing with non-banks. And also, I think they're going to look at regulation and the climate agenda on on all the currency issues that Nathan and I used to deal with. I expect her to be much more mainstream, adhere to the kind of policies articulated that when we were at Treasury, as opposed to what you've seen in the last four years. And in this sense, I think she'll go back to the mainstream, and just a lot more thoughtfulness than we've seen over the last 4 years when looking at kind of economic policy issues.
Thank you, James. Just quickly on the point Mark's just made on bank regulation. Of course, you work for a universal bank. They had a difficult time after the last crisis with regulators making life more difficult for them for all the reasons that we understand. With your corporate hat on, so to say, are you concerned about bank regulation from the Elizabeth Warren wing of the Democrats, making life more difficult for institutions such as yours? I realize you're not an official spokesman for Credit Suisse in this regard.
Well, I think the Biden administration embraces the Basel III set of reforms, the Dodd-Frank set of reforms that came in the aftermath of the last crisis, and banks have spent the last 10 years recalibrating for those new reforms, including a polygon of constraints where any given bank might face a quite different binding constraint from other banks. So it's very unlike, an old textbook, reserve requirement or something like that as a universal binding constraint. So we have a jumbled environment, but it's not going to change. And I think, you're looking at consumer protection rules potentially shifting, but the general treatment of financial market regulation is not expected to be underturned under the Biden administration. Some progressives may scream for something other than that, but I don't think it's going to happen. And so it just is what it is.
Okay, that's interesting, useful. Nathan, you wanted to come in?
I'd just like to add that I very much agree that in some sense, Trullo did the work for the large banks and the largest financial institutions. And Randy Quarles kind of tapered it a little bit or tailored it a bit. But I don't think the Biden administration is going to make huge changes there. If there are going to be more vigorous efforts on financial regulation, it's much more likely to be in the non-bank financial sector, areas that haven't been as regulated to date. Here I'm thinking about money market mutual funds and some of the ETFs in illiquid sectors that nevertheless promise instantaneous liquidity, leverage loan underwriting and this kind of thing, that there is work to be done there. But it also gets very tricky as to who has the statutory mandate to get it done. And it may actually require legislative support, which could be a high bar. But in any event, we'll see Janet Yellen empower the FSOC again, which was a pretty powerful vehicle under Tim Geithner, and try to use that to drive financial regulation in some of these non-bank issues.
Thank you. James, just back for a moment on full employment and indeed your piece on inflation and therefore the neutral rate of interest and so forth. We've heard about a big stimulus. We've heard about changes to minimum wage, so improving the pricing power of people at the bottom end of the income scale. We know that the Fed wants that. We've heard about infrastructure spending. Financial markets are extremely excited and asset valuations are pretty high. Are we underestimating inflation risk? And then we'll go on to what that may mean for interest rates and indeed the cost of government debt. What do you think, James?
Well, when the economy is below full employment, the policymakers have low-hanging fruit. They can do a lot of stimulus, fiscal and monetary, without necessarily worrying about the long-term risks, because they can argue that sustained inflation is not around the corner, and getting the economy back on a proper nominal trajectory will actually help the budget dynamics longer term. And so this year, we're likely to see a significant increase in year-on-year inflation in the first half of the year, driven really by base effects. In the second half of the year, a lot of people expect inflation to come down, but there's real questions about the elasticity of supply and services sectors and whether people return and all of a sudden, a hotel room costs $1,000 and some components of the inflation index are leading to high inflation. What I'm wondering about is something different, though. What about when the low-hanging fruit is done and when we're back to full employment? And maybe this is 2 years or more away, and I would put U.S. full employment somewhere in the 4% area. The question is, at that point, what is the path of interest rates? And I think there's been a very strong consensus view articulated that the path of short rates way out will be extremely low. Neutral rates are low, R-star is low, and will stay low. And I understand those arguments. They're related to demographics and technology and, frankly, forces that are so big and broad that we should probably have a little humility when we're talking about where R-star or where neutral rates will be 3 to 5 years out, because I find in so many of these discussions, it is an ironclad assumption that these neutral rates will stay low. And I wonder, with all this stimulus, with an eventual return to full employment, even with a short-term overshoot in inflation potentially coming this year, whether neutral rates might rise more than expected. And if they do, most economists would say, well, that's fine. We'll have some inflation, we'll have some revenue, it will be great. Well, okay. But what if political constraints, limit the ability of policymakers to withdraw? What if rates can't track neutral rates up? Do we worry about bubbles in financial assets? Do we worry about an overshoot in inflation that's potentially more persistent down the road? Do we worry about interest rates finally following those neutral rates up, maybe needing to go even higher, much higher than expected? And therefore, the low debt service, which every government, firm, and household in the world seems to assume right now for the indefinite future, turns out not to be the case. That's the world, not necessarily of financial disaster, but of financial chaos, at least, with big winners and losers, and where financial stability can be disrupted in interesting ways. There were financial stability issues in the 1970s that were pretty interesting. The S&L crisis had its roots in yield curve moves in the 1970s. So I'm not predicting anything like that, just suggesting that we shine a risk shine a light on the risk that, we don't know where neutral rates are going to go. We don't know how interest rates are going to play out. And it's not just inflation. It's what is the appropriate short rate, and what does that mean for the financial world's assumptions about the coming years? The world has changed from this pandemic, and I think we need to be humble in thinking of the range of possibilities that we could see in the next 5 years.
Thank you. Nathan, your institution, of course, has a huge vested interest in this, but I'm going to come to that in just a moment. So I know that Mark is or has been a bit of an inflation bear, thinks that central banks have spent 10 years trying to create it and have repeatedly failed. Are you changing your mind about that, Mark? What's your view on James's tentative hypothesis that we might be seeing the end of that now?
James outlines a perfectly plausible scenario. My main point would be the one that he made, which is we have an output gap now, and we're nowhere near close to full employment. So it would be nice to see inflation a little bit. I think the Fed will presumably take a different view of a supply side boost to inflation because of supply chain issues now versus what would be a kind of a demand side and a durable increase in prices. I'm just waiting to see that. Maybe by then it'll be too late, but I think the costs of premature withdrawal of support are too great now.
Thank you. Nathan, over to you. All sorts of things will happen if interest rates are obliged to go up. What are you expecting at PGIM?
My feeling is that as the economy snaps back during 2021, we could see some shortages, bottlenecks, and other kinds of constraints on the supply side of the economy, which could push up inflation during the second part of this year in particular. Well, my sense is that that is going to be a mirage, and that as you move into 2022 and 2023, that inflation is going to come back down, and the global environment, the US environment, is going to feel a lot like pre-pandemic. That I think the drivers of inflation are really rooted in a lack of aggregate demand in the economy. Aging demographics, high debt levels kicking off deleveraging, and some other kinds of structural forces. And so my strong expectation is as you move into 2022, inflation will come back down, likely again below the Fed's 2% target, and rates are going to have to remain low, rates remain low, at least through the end of 2023, as the Fed has indicated in its projections, but maybe beyond that. And similarly, long-term interest rates will be at historically low levels. Over time, whether that means they'll be above or below 1%, I think is an open issue, but they're going to be historically low. So I say that with some confidence, at risk of sounding like I am lacking in humility, because the risk that James articulated is one that all of us need to pay careful attention to. But when I think about my risks out there, that's not the one that's at the top of the list.
Just briefly, we're going to wrap up now, and thank you everyone for listening. Just briefly on that, Nathan, in terms of government borrowing and managing the yields there, how significant do you think that is? I mean, we have these days friendly central banks that can help out with the cost of government borrowing. Do you think that will be a material issue?
Bottom line, it seems like there's a lot of demand for treasuries. There will be supply out there. It will be rising supply over the next few years, but between the Fed and other public and private institutions in the United States and around the world, it seems that there's plenty of demand. And you see that essentially today as we speak in the treasury market with these very low yields.
Okay, thank you very much. And thank you, James, Mark, Nathan, for a very, very useful session today to get a feeling for politics and economy over the coming year or so. I thought it was very useful indeed.